Last week, Chancellor Rachel Reeves delivered the autumn budget, which presented a series of fiscal measures aimed at stabilizing the UK economy, addressing the ongoing cost of living crisis, and ensuring long-term growth. With public finances under pressure, the Chancellor has outlined a plan to increase tax revenues while also providing targeted support to households and businesses. Here's everything you need to know. The 2025 budget introduced several major updates for UK businesses. The secondary threshold for employer national insurance contributions will remain frozen at £5,000 until April 2031, extending the position established in last year's autumn budget. This means employers will continue to pay 15% national insurance contributions on employee earnings above this relatively low threshold for the foreseeable future. For smaller businesses benefiting from the employment allowance, doubled to £10,500 last year, and in effect from April 2025, the impact remains manageable. However, employers without access to this relief will see their payroll costs remain elevated compared to pre-2025 levels. The budget also continues to support businesses through the Small Business Rates Relief Scheme. From April 2026, the grace period for businesses expanding into a second property will be extended, allowing businesses to retain their relief for an additional 2 years. This measure is expected to help SMEs manage costs as they grow, offering more stability during periods of expansion. This will particularly help those in the retail, hospitality, and leisure sectors. The main corporation tax rate remains at 25%, and full expensing continues for qualifying plant and machinery. However, the budget introduces 2 significant changes for other categories of capital expenditure. From the 1st of January 2026, a new 40% first-year allowance will apply to expenditure allocated to the main pool, which will benefit a business which is unable to use the existing first-year allowance rules, or has already exceeded the annual investment allowance limit. In addition, from April 2026, the main writing down allowance will be reduced from 18% to 14%, increasing the time it takes for businesses to obtain tax relief on remaining expenditure. These changes affect assets that do not qualify for full expensing and will be particularly relevant for businesses making substantial ongoing investment in plant and machinery. The annual investment allowance remains unchanged at £1 million, with no new restrictions announced. For innovation-driven businesses, the government has increased the eligibility for the Enterprise Management Incentive Scheme. From April 2026, companies with up to 500 employees and gross assets of up to £120 million will be able to offer tax-advantaged share options to a broader pool of employees. This change will help fast-growing companies attract and retain the talent they need to scale, boosting the UK's entrepreneurial ecosystem. As part of the government's long-term strategy to address road usage and carbon emissions, a mileage-based tax on electric vehicles and plug-in hybrid vehicles will be introduced from 2028. The tax will be set at 3 pence per mile for electric vehicles and 1.5 pence per mile for plug-in hybrid vehicles. This new charge is designed to ensure that electric vehicles owners contribute to the maintenance of public infrastructure, much like traditional fuel taxes do. The Autumn Budget 2025 outlined significant announcements for personal taxes, which are designed to address growing fiscal pressures and raise additional tax revenue. A headline announcement: income tax and national insurance thresholds will remain frozen until 2031. This freeze affects both the £12,570 personal allowance and the £50,270 higher rate threshold. As wages rise in line with inflation, more people will be drawn into higher tax bands, a process known as fiscal drag. By 2029-30, an additional 780,000 people will be paying tax at the basic rate of 20%. 920,000 more will fall into the higher rate of 40%. and 4,000 more will be subject to the additional rate of 45%. From April 2027, the government will introduce separate tax rates for property income, distinct from other income tax bands. The new rates will be 22% for basic rate taxpayers, 42% for higher rate taxpayers, and 47% for additional rate taxpayers. These changes will impact landlords and property investors, particularly those with larger portfolios or those transitioning into higher tax bands. Landlords with properties generating significant rental income will need to carefully assess the tax implications of these new rates and consider any changes to their portfolio structure in advance. The annual ISA allowance remains at £20,000, but from April 2027, the way this can be allocated between different types of ISAs will change. For individuals under the age of 65, £12,000 will be the maximum amount that can be invested in a cash ISA, while the remaining £8,000 must be allocated to a stocks and shares ISA. This change aims to encourage more investments in stocks and shares, which are generally seen as more effective for long-term growth compared to cash savings, while still allowing for tax-efficient savings. Although the budget does not change the main capital gains tax rates, it does tighten some of the most generous reliefs. From the 26th of November 2025, the capital gains tax relief on qualifying disposals to employee ownership trusts will be reduced from 100% of the gain to 50%, so half of the gain will become chargeable. In addition, previously announced reforms mean that, from the 6th of April 2026, gains eligible for business asset disposal relief and investors' relief will be taxed at 18% in line with the main lower capital gains tax rate, rather than at the older, lower preferential rates. Together, these measures mean that business owners planning an exit via an employee ownership trust or a relief qualifying share sale are likely to face higher capital gains tax bills than under the previous rules and should factor the new rates and timings into their succession planning. The government has confirmed significant wage increases for workers from the 1st of April 2026. The national living wage will rise by 4.1%, reaching £12.71 per hour for those aged 21 and over. This increase will benefit around 2.4 million low-paid workers, adding £900 to the annual salary of a full-time worker. Meanwhile, the national minimum wage will rise by 8.5%, reaching £10.85 per hour for 18 to 20-year-olds. This will provide a £1,500 boost for full-time workers. The national minimum wage for 16 to 17-year-olds and apprentices will also increase by 6% to £8 per hour. The budget introduces a cap on the national insurance relief available for pension contributions made via salary sacrifice. From April 2029, only the first £2,000 per person per year of such contributions will remain exempt from national insurance. Any contributions above this threshold will be treated as standard pension contributions and will attract both employee and employer national insurance at the usual rates. High earners or business owners using salary sacrifice to maximize pension contributions should reassess their remuneration and pension strategy. The post-2029 benefit may be significantly lower than before. Employers offering pension salary sacrifice as part of remuneration packages may face increased national insurance costs and might want to review the structure of those benefits. For lower and middle-income individuals, the impact will be limited if total salary sacrifice contributions stay below £2,000. Nevertheless, this highlights the importance of reviewing pension saving plans ahead of the 2029 change. From 2028, a new high-value council tax surcharge will be introduced for properties valued at £2 million or more. The surcharge will be phased at £2,500 per year for properties valued between £2 million and £5 million and £7,500 per year for properties valued over £5 million. This is in addition to regular council tax. Inheritance tax thresholds remain frozen until 2031. Agricultural and business property relief will be capped at £1 million per person. And from 2027, unspent pension pots will form part of an individual's taxable estate. This change will affect retirement planning strategies for those with significant pension savings. Alongside tax rises, the budget introduces several measures to protect vulnerable households. A significant change to universal credit will come into effect in April 2026, with the removal of the two-child limit. This change will benefit an estimated 560,000 families, with each receiving an average increase of £5,310 in their benefits. The removal of the cap is expected to cost £3 billion by 2029-30 and will significantly reduce child poverty among these families. Spending on disability benefits is also expected to increase due to a rise in caseloads. With more individuals seeking support and higher average awards, the government projects an additional £1.4 billion in welfare spending by 2029-30. In response to ongoing cost of living pressures, especially in relation to energy bills, the government has implemented measures designed to ease this burden. The budget includes policies aimed at reducing CPI inflation by 0.3% in 2026, partly by lowering household energy bills. These reductions are expected to provide some relief to families facing high utility costs, which have been a major concern in recent years. The budget announced a freeze on regulated rail fares in England, marking the first such freeze in 30 years. This means that season tickets, peak return fares for commuters, and off-peak returns between major cities will not rise next year. The budget also extended the freeze on NHS prescription charges in England, keeping the fee per item at £9.90 for 2026-27. This freeze also applies to 3-month and annual prescription prepayment certificates, helping to manage costs for people who rely on regular medication. This autumn budget raises significant revenue through frozen thresholds, higher taxes on wealth-based income, and new levies on property and electric vehicles. But it also delivers substantial support, especially for low-income families, disabled individuals, and key sectors of the economy. For further details, download our comprehensive autumn budget report. If you would like to discuss any of the matters from the budget, please do not hesitate to get in touch with the Plus Accounting team.